The following podcast was recorded on Wednesday, May 29th, 2024, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
Today, Jim will share his thoughts on the state of the U.S. deficit. Jim, can you put in perspective the debt and deficit for us?
Yeah, a lot of people talk about this and, they throw out some numbers or some platitudes about it, but let's put some numbers and some charts on it. So if we go to the first chart, the amount of borrowing that the federal government has done, so this is the total debt outstanding through the end of April, is about $34.5 trillion. It is rising at about $1 trillion every 100 days or so. It's a hard number for everybody to get their head around. But a better way of measuring this is to look at it as a percent of GDP. So if we go to the next chart, and yes, there is data back to the signing of the Constitution on this stuff. One of the things the Treasury Department has done is kept good records on it. So here is the federal debt as a percent of GDP. What jumps out on this chart is two things, actually three. First of all, there was that peak in 1943 or so at around 120%. That was to finance World War II. And then the debt fell as a percentage of GDP, meaning that the economy grew faster than debt rising until the 1980s, and it started back up again. And only during COVID in 2020 did it actually exceed that World War II peak. And the red line on the chart there is the Office of Management and Budget, which is part of the White House, does project the next 5 years. It's their guess, and their guess is no better or worse than anybody else's guess. And so they still have it at around 125%. So that is the amount of debt. So the debt is larger at $34 trillion than roughly the $30 trillion economy that we are. Go to the next chart. Let's talk about the deficit. So the deficit is, taxes less spending. And if you spend more than taxes, you have to borrow. How much are you borrowing? That's your deficit. Top panel shows you that the deficit, this is rolling 12 month, through the end of April was $1.6 trillion. So the government was spending $1.6 trillion more than it was bringing in taxes. Bottom panel shows you that it is roughly around 5.5% of GDP. Now on the bottom panel, I have a dotted line, and I've shown that the deficit is larger now than any other period that we've seen other than the financial crisis in 2009 and COVID in 2020. Now, before I comment on that, let's go to the next chart. And I want to just kind of put this in perspective with the next two charts, and then I'll comment on it. How do you get to a deficit of $1.6 trillion? So the top panel shows you in blue the amount of government spending, which is about $6.3 trillion. And the bottom panel, or the orange line in that panel, the lower line, shows you that the amount of government taxes is around $4.7 trillion. That gets you that middle panel, the $1.6 trillion deficit. Bottom panel shows it to you in a different metric. And that different metric that it shows it to you is that it is a percent, how much of taxes makes up total government spending. And it's about 74.4, let's call it 75%. So in other words, our taxes cover 3/4 of what the government is spending. They borrow the other 25%. That's the $1.6 trillion deficit, or equivalent to about 5.5% of GDP. Now the next chart shows you the deficit as a percent of GDP as going all the way back to the 1790s. And you can see that other than COVID, the financial crisis, World War II, World War I, Civil War, major events in American history where we had the very existence of the country was at risk. that we borrowed tremendous sums of money to get through these events. Those are the only times that the deficit as a percent of GDP has been higher than it currently is right now. And then the final chart in this block, at least, is federal taxes as a percent of spending. So you can see that shows you how much does the government raise in taxes that it spends. Guess what? The average over the last 200 years has been 100%. So it raises exactly as much money as it needs to spend. But lately we've been running in around the low 70s, meaning that we're borrowing about 27% to 25% of our spending. So let me put this into a perspective. The government is what they call Keynesian cyclical, and it's a word I'll use. In other words, they believe that when the economy turns down and there's risk of recession, we should be spending a lot of money to try and stimulate the economy out of recession. But when the economy is recovering, we should back off on that spending so that we don't wind up having, too much debt. That's what's different now. We spent an enormous amount of money to get us through COVID. I'll show that in the next set of charts. But then after COVID ended, we never stopped spending. And so we are spending as if we are in a recession, trying to stimulate the economy, but we're not. We're in the fourth year of a recovery. That's why my long-term thesis has been there's going to be no soft landing. There's going to be no hard landing or recession because the government is flat out spending too much money. It keeps the economy moving forward. That sounds great, except it creates inflation. And we could see the amount of pain and angst. Look at the presidential election. Look at the president's approval rating. Inflation is the thing. The cumulative impact of inflation in the last 4 years has been devastating for a lot of people, especially in the lower half of income. That's the consequence of having all of this spending.
Jim, tell us more about government spending.
So if we go to the next chart, let's start with this one. Actually go to the next chart after that one. Yeah, this one. Government spending as a percent of the economy, GDP. So this is now not the deficit, but just how much does the government spend? As of April, it was 22% of government spending was 22% of GDP. I got a dotted line on that chart. The government is spending more money now than it did at any other time, except trying to pull us out of the financial crisis in 2009 and that big, huge amount of spending, the stimulus checks and everything else in 2020, 2021, when we were trying to get out of COVID. So if we go to the next chart shows you government spending as a percent of GDP back to 1790. And I got the dotted line on that chart. There's only been 2 times in American history that the government has spent this amount of money on a yearly basis, not on a necessarily a 12-month basis, COVID and World War II. And so what we're seeing is massive, massive government spending on a scale that we have never seen before. This is why the deficit is so big. This is why we seem to see that the debt just keeps growing to the sky. Now, what's the consequence to all of that spending? If we go to the next chart, it's the one that everybody's been focused on has been the amount of money that we have to pay in interest expense. So the top panel, this chart goes back to World War II. The top panel shows you interest expense flat out, and it just went over $1 trillion. The bottom panel shows it to you as a percent of GDP. And then I've got the standard deviation and the average on the shaded areas on there. And we're up at around 3.7%. So to put this number in perspective, because these are big numbers, no one understands it. Let's go to the next chart. And the next chart shows you that the blue line is that $1 trillion that we spend to service the debt, pay interest on the debt. And the orange line is Defense Department spending. So we're spending $1 trillion a year on interest expense, and it's going straight up. And what we see also is that we only spend about $750, $800 billion in Defense Department spending. So we're spending $200 billion more in interest on debt than we have been spending on the Defense Department, just to give you an objective measure of how to look at this. So if we go to the next chart, this shows you the average interest rate that the government is paying. Now, we all know that, Treasury bills are at 5.3%. The 10-year yield is at 4.6%. The 2-year yield's at around 4.95%. So all of government borrowing is in the high 4% to low 5% range. This shows you the average interest that the government is currently paying. It's 3.23%. Why is it so low? Because they issued bonds when we had 1% and 2% interest rates many years ago, and they're still paying them off. But as those bonds mature, they have to roll into higher coupons. That line is going straight up. That line of average interest costs will go straight up for the next year or two, regardless of what the Fed does. If the Fed cuts rates, or if the Fed doesn't cut rates, they're not going to magically take interest rates from 5% down to 1% in order to get that line to stop going up. But if they cut rates once or twice, it's not going to matter. That line is going to keep going up. Interest expense is going to keep going up. So if we go to the final chart in this section, what it shows you is net federal interest costs as a percent of GDP. So the green line is what I showed you before. It's 3.7% of GDP is what we're paying in interest expense. The red line is the Congressional Budget Office's estimate over the next 10 years as to where that number is going to go, and it's going to continue to go much, much higher. So we're destined to continue to see interest costs go up, even if the Fed were to cut interest rates now, and 2 rate cuts, 3 rate cuts won't change this equation. 10 rate cuts would change this equation. Of course, the problem is if you cut interest rates by 2.5%, and you still have this level of spending, as I've argued, you might produce 6 or 7% long bonds because the market might freak out that you're just creating more inflation. You're creating too much stimulus, and we'd have more inflation at that point. So far, what we've talked about is the deficit and the debt are at record levels. We used to be countercyclical when we would spend a lot during a recession to kind of stimulate us out, but back off when the economy recovered. We never did the back off part. That's why the deficit is so big and so monstrous. It is now larger than the Defense Department spending, and the deficit is continuing to soar to levels that we have not seen before.
So how does this get resolved?
To use the line from Rocky III and Clubber Lang, with some pain. It's going to be pain. Now, let me be clear. There's 2 ways you can resolve this. Resolve it way 1 is we elect some kind of Hamilton and Jefferson 2.0, and that they come in, they see that this is an unsustainable situation, and then they all agree that we should rein in spending. We've been trying to do that for 200 years, and we haven't found that Hamilton and Jefferson. And I feel fairly confident to say they're not on the ballot this fall, neither one of them. And I'm not even talking about Trump. Trump and Biden are definitely not on the ballot, because as I've described it, Biden is saying, I want to spend $6.2 trillion over here. And Trump is saying, no, you're wrong. I want to spend $6.2 trillion over there. But they're going to continue to spend this kind of money is what they're going to do. So that's not going to change the equation. So if we're not going to voluntarily elect officials that are going to rein this in, they'll talk about it forever, but they won't rein it in. What's the next option? So if we go to the next slide, look to the UK in 2022. That's the famous meme, can Liz Truss outlast a head of lettuce? Now remember, Liz Truss was a Tory conservative UK prime minister. She came in August of 2022. She proposed their budget, which they referred to as the mini budget. She wanted to cut taxes, reduce the number of revenue, increase spending, the deficit in the UK go up. Parliament, their Congress said, oh, okay, we're good with this. And the bond market was not good with this. So if we go to the next chart, here's the 30-year gilt yield on the top panel. And on the bottom panel is its 5-day change. In the 5 days ending September 27th, 2022, The 30-year gilt, like our 30-year bond, went up 140 basis points or 1.4%. The Bank of England has 300 years of data, and this has never happened in 300 years. When interest rates went up like that, it created the liability-driven investing crisis, or it created a financial crisis. The financial system in the UK was not built that what would happen if interest rates shot up 140 basis points in a week. It would create havoc in the financial system. And that then forced the Parliament and Liz Truss to say, look, we have to get confidence back in the government. We have to get confidence back in the UK gilt market. We can't pass this budget. We have to rein in the amount of spending that we're going to do. And the bond market put its foot down, stopped the spending. Liz Truss, as the UK Prime Minister, lasted 47 days. She will forever be the answer to the trivia question, who was the Prime Minister when the Queen died? Because that's what happened in her 47 days, other than this budget debacle. Those are the only two things that happened in those of consequence. So this is how it ends. The bond market puts its foot down and it says, enough. You're done with the spending, meaning bond investors don't want to buy bonds anymore because it's not a good deal. I'm not being compensated for the amount of supply risk and potentially inflationary risk because of all the stimulative effects of all this government spending. Rates go to 5%, then they go to 5.5%. And then Congress comes out and says, well, we can't cut spending because we got all these important programs in their life and death and they matter. Okay, we'll go to 6. Well, but we can't really cut spending. We'll go to 6.5. Should I keep going? And eventually when rates get high enough, something in the financial system blows up, like the liability-driven investing. And then Wall Street comes to Congress and says, look, we're done here as an economy unless you stop spending. And then they're forced to stop and rein in the spending. Now that I've said that, that's a very dire circumstance that I've said. I would say I'm unfortunately confident that that's where I think it's going to end, unless you can make a case to me that there is going to be, you know what, we're just going to stop spending some Thursday because something bad might happen in the future. And I'm sorry for all the poor people that we're trying to help with all the spending. We just can't do it. I say it sarcastically to get my point across. We're not going to do that. That's why I think it's going to have to be a crisis. But now that I've said that, does that mean that's later this year? Or is it in 15 years? Or is it somewhere in between? I don't know. No one knows. No one knows when the bond market reaches that breaking point that it drives rates so high that it stresses the other parts of the financial system because of injuriously high interest rates and forces that change. My guess is all this government spending just keeps building and building and building more and more inflation. And it's that more and more inflation that drives these rates higher and higher and higher. And the only thing that's going to stop the inflation is to stop the stimulus. So you have to stop spending as much money as we have been spending, and that will bring down the inflation rate. Now, it doesn't look like we're anywhere near that now. Yeah, I know the day we're recording, interest rates are up about 15 basis points over the last couple of trading days, but they're at 4.62%. Now that's high relative to what we've seen over last year, but they've been I'm talking about 4.62 is the 10-year yield. We've been to 5% last October. These are not bone-crushing levels on interest rates. Short-term interest rates haven't moved in a year. They are drifting higher, but we're not anywhere near those levels that just drive everybody to their knees and say, Congress and the president, you have to stop the spending to bring interest rates down because they're suffocating everything. We're not there now. I don't know when we're going to get there, but unfortunately, like I said, make me the case we're going to elect some people that are just going to say no more spending. Even if it's all Republicans, which is what probably people think, they have a history when all Republicans are in charge. They basically, I hate to say it, they like to say no more spending on Democrat priorities. We're going to spend on our priorities. We're going to spend more on the military or something like that. That's kind of the way it works in Washington. Power is spending and no one wants to reduce their power. And that's why the only thing that's going to be is going to be the financial markets when they've said enough. And we saw an example of that 2 years ago in the UK.
Jim, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Arbor Research, Bianco Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks everyone, and have a great day.